First, we're going to take a closer look at our top story on how global central bank chiefs are giving banks 4 more years to meet those international liquidity requirements. And joining us now for more is Wallace Turbeville. He's a senior fellow at Demos, a public policy research organization here in New York. Wallace, thanks for joining us tonight.
Thanks for having me here.
Wallace, the Basel regulations were implemented after the financial crisis in 2008. They wanted banks to have more cash on hand to prevent another Lehman-like collapse. So is this relaxing of standards in the long run potentially going to jeopardize the health of the banks?
It's going in the wrong direction from that perspective. Because what's happening is they're allowing the banks to put these cash reserves into things like equities, shares of companies, and remarkably, mortgage-backed securities, which were exactly the kinds of things that became completely illiquid and unsellable in 2007, 2008. So there's no doubt about the long-term effect of what they're doing.
So it's back where we started. Seems like not much of a lesson has been learned from previous experiences.
At least the one thing that they will say, and the UK regulators have said even today, this is the first time there have been any rules at all about the kinds of liquidity of the kinds of securities that these banks have on hand. Can you sell them? Not are they going to be good if you hold them till they mature, but can you sell them and convert them to cash? So at least they have a nod to that. What's hard to imagine is why they picked the kinds of securities they did and classify them as truly liquid and convertible to cash.
Yeah, now you've mentioned liquidity quite a bit here, and one of the regulations involves the liquidity coverage ratio.
Correct.
Which has changed and which has also been postponed until 2019. Tell us a little bit more about what this rule means.
Right. What it really means is, if some of your viewers have even seen that Jimmy Stewart movie, It's a Wonderful Life, where everybody goes to the bank and wants their money out, and the bank doesn't have the cash. Well, there are modern versions of that, and that's what happened in 2008. It was really other banks wanted their cash out. So the fact is that whatever securities are on hand, if they're going to count towards having cash on hand, they have to be easily convertible. So convertible to cash, which means you have to sell them. And the banking word for that is liquidity. Can you get the securities converted into cash at a predictable price?
And now they've made it easier for banks to declare that they can convert what they have at an easier price. And we saw global banks, our shares rising on this news. Why is this good news for banks?
Well, there's short term and there's long term. In the short term, what it means is that the securities that the banks can invest in will have a higher yield. So what will happen is that the banks will be more profitable. That's one hand.
Right.
The other hand is the long term, and is the long term prospects for the bank and if they're going to be operating prudently. So in my view, long-term prudency and solidity of the banking system is more important than short-term profitability.
But in the short term, it does help the consumer and businesses because lending standards should be loosened, allowing more credit to flow out, right?
That is true. There will be more profit. There will be more cash on hand to lend. I think that you got to be careful in jumping to the conclusion that means that the lending coffers will be opened up, because there are other reasons that banks don't lend. It has a lot to do with, are there good credits to lend to? It's whether there are opportunities to lend as opposed to just having the cash on hand to lend.
Now, very quickly, let's touch on the Bank of America deal that we saw today. Bank of America settling with Fannie Mae for $10 billion. Is this finally the end of this chapter for B of A?
I think that the book, let's go beyond the chapter to the book is mostly done. In the last 3 years, B of A has settled for $43.5 billion in aggregate in a whole series of different proceedings. I think that B of A has taken some steps to put some of these things that have been hanging over its head behind them. The Fannie Mae situation has been really problematic for a year, and in part because Fannie Mae was no longer allowing Bank of America to sell mortgages to them, and that was really because of this dispute that's been settled today. So if the dispute is settled today, and if the next step occurs, which could well happen, Fannie Mae starts allowing Bank of America to sell the mortgages to them so that it gets the process going. That would mean that the mortgage business at B of A would potentially expand and go back to somewhere what it was like before.
So hopefully B of A putting that behind it. Another big settlement as far as banks concerned today. 10 mortgage lenders, including Bank of America, JP Morgan Chase, Citigroup, agreeing to pay more than $8 billion to settle allegations of widespread abuse of the foreclosure system, which allowed banks to seize homes from defaulting from borrowers. This is a win for consumers, but what does this mean for the banks?
Well, again, this is closing a chapter. There was a process that's been going on for a while where mortgages, foreclosure procedures were being reviewed, and the review process was very cumbersome. It was a glacial process. What this means is that these banks, these top 10 banks, in terms of mortgage lending, have got that behind them now. And what they said is, we'll pay this money and we'll forego this grinding process that's been going on to try to get the mortgage foreclosures correct on a case-by-case basis. So what they've done is, again, put something behind them. And I think that's generally good.
Okay, so a lump sum settlement to just throw some money at the problem.
That's correct. Yes.
Okay, thank you so much, Wallace Turbeville, Senior Fellow at Demas.